Do you want to know how to invest in REITs? Then watch this show till the end. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to talk to you about REITs, and I want to have a conversation around whether or not you should add this asset class to your portfolio. And I'm going to also talk about the pros and cons of investing in REITs. As an asset class, though, real estate should be a part of every balanced investment portfolio. Why? If you really think about it, real estate investments traditionally have a low correlation to stocks, right? So when stocks zig, real estate typically zags. So this provides your overall portfolio with stability. Financial advisors and industry experts, they seem to agree that anywhere between 10% to 25% of your investment should be in real estate. So I'm going to really kind of get into the nitty-gritty here and explain to you what we mean by REITs and REIT investing as a long-term investment strategy. Let's first define what REITs are. So REITs, aka Real Estate Investment Trust, they are an alternative to buying real estate directly. So if you don't have $100,000 or $200,000, or you don't have the time or the willingness to buy property, to buy real property, you can invest instead in REITs. So REITs offer some of the most attractive features of stock investing. REITs have been popular investments since their creation in the 60s. So you want to think of a REIT as a pool of real estate assets traded freely on the stock market exchange. Just like any real estate investment, just like real estate properties, just like physical property, that is, REITs can invest in many categories and many geographical regions. So real estate is typically broken down into the following categories. You have industrial and office, retail, residential, lodging and resorts, healthcare, self-storage, and specialty. So now that you understand the different categories of REITs that you have out there, the big question is, should you invest in REITs? Now, this show is not about providing any kind of financial advice. We're doing research, and this is more an educational video. And you have to have a longer conversation around your financial goals, your risk profile. You need to know exactly what kind of goal you have in terms of investments. Are you looking for appreciation of the asset class? Are you looking for fixed income? Are you looking for periodic payments? Are you looking for some kind of are you trying to hedge your portfolio? Those are questions that you can have with your financial advisor or with yourself if you have a knack for finances and you know exactly what you're getting yourself into. Because investing in REITs can be done by nearly any investor, regardless of portfolio size, because REITs are available in mutual funds and ETFs. So if you're just starting, you want to consider a REIT index fund. There are many to choose from, including the iShares Cohen and Steers REIT ETF. That's the ticker symbol is ICF. You can choose the Vanguard Real Estate ETF, the VNQ, or the Vanguard Real Estate Index Investor, the VG6. So that's the first option. Another option is to check out one of the crowdfunding platforms that offer REITs. And you can have Streetwise, for example, STREITwise. And by doing that, you are having the opportunity to invest in private real estate deals with a low minimum investment of just $1,000. Now, you have to remember, though, that not all crowdfunding platforms are REIT centric. So if you are an accredited investor with at least $100,000 to invest, you might be interested in the private equity firm. There are several private equity firms out there, and you're able to tap into one of the sophisticated equity firms, PE firms out there, and you can earn more money based on those private equity deals. So you have to also understand that it's also about your investment horizon. This is very important. Your investment horizon is are you willing to wait for years, or are you sort of interested in earning money quickly? So you have to think about that. investment horizon, and the category of REIT you're invested in, whether it is industrial and office, retail, residential, lodging and resorts, healthcare, self-storage, specialty. I'll be right back right after this. Do not go anywhere. So welcome back to another session of the Awesome Sweetie Kiwi Show. I'm talking to you about how to invest in REITs. I've already explained to you that REITs are basically, they're typically similar to, you buy and sell them the way you would do an ETF or mutual funds and they're traded on a stock market such as the New York Stock Exchange or the London Stock Exchange. And let's talk about the advantages of REITs invested. There are many pros when it comes to REIT investing. So you have guaranteed dividends. You have hassle-free real estate investing. You have low minimums, passive investments. There is a low stock market correlation, liquidity, better performance, and there are mandatory distributions to investors. So REITs, when it comes to guaranteed dividends, REITs must pay out at least 90% of their income as dividends. So management can raise the payout to more than 90%, but by law, they cannot lower it below 90%. So this requirement is the number one reason income investors buy REITs. You have hassle-free real estate investing, so they're conveniently packaged into shares that can be easily bought and sold. So there are also REITs, mutual funds, and ETFs that diversify by investing in many individual REITs. The minimums are low, so you don't need a lot of money to start investing in REITs. And guess what? Owning a REITs index fund gives you exposure to the real estate asset class with very little money. It's a passive investment vehicle because directly owning and managing a property is a business and requires time and effort. REIT shareholders don't own the property or mortgages represented in its portfolio. As such, they also avoid the headaches many property owners and managers experience, such as maintaining or developing the property, providing landlord services, and collecting rent payments, to name a few. So REITs are truly a passive investing like mutual funds. And as I said earlier, the REITs also have a historically low correlation to other asset classes. So this makes it very easy to create a diversified investment portfolio by adding REITs. Liquidity. Unlike owning property directly, you can quickly sell a REIT if you made a mistake, right? So traditional real estate has a long enter and exit process, so your investment is not that liquid. In terms of performance, that's kind of cool too, because REITs have historically experienced diminished performance when interest rates increase, but many REITs outperform other investments even in the face of high interest rates, and REITs often outperform other stocks in a slow economy. And the last thing that I was also talking about is that you have mandatory distributions to investors. So REITs are companies whose assets consist mainly of real estate holdings. So this gives them favorable tax treatment. In exchange, they must distribute, as I said earlier, at least 90% of their income to unit holders. So this pretty much guarantees payouts to investors. So that is about the advantages of REITs investing. Let's talk about the disadvantages. What are the cons of REITs investing? So when you buy a REIT, you are in essence becoming more of a real estate investor than a dividend stock investor, and that are potential risks to consider. So you have declining value properties, you have fees and markups, potential market correlation, gains are taxed at ordinary income rates, and there is an inherent potential limited growth. So declining, the declining value properties is kind of it's a major risk here, because as we've learned through the housing bubble that burst in 2007, 2008, real estate doesn't always go up in value, right? So when choosing a REIT, you got to be mindful of the growth prospects of the industries, property types, and geographical locations it is targeting. This kind of makes sense. This is like basic analysis. You got to think about fees and markups too. What are the fees and markups? So REITs offer the advantage of liquidity. However, trading in and out of a REIT has a high cost because most of the fees charged by a REIT are paid up front. So those fees are roughly 20-30% of the value of the REITs. So this takes a sizable chunk out of your potential returns. And because REIT prices are setting in the public markets, they can trade at a significant premium to the real value of the underlying asset they hold. There is potential market correlation. Some publicly traded REITs tend to be highly correlated to the broader stock market, even though, as I said earlier, most are not. But when you have a correlation, that means the prices for some REITs can go up and down with corporate stocks, regardless of whether the underlying values of the properties within the REITs have changed. So you'll want to be careful that the REITs you choose for your portfolio provide the diversification you're seeking. The gains are taxed at ordinary income rate. So REITs, of course, as I said earlier, they have to pay out 90% of their income to their shareholders. So this gives many REITs attractive yields. But unlike stock dividends, which are currently taxed at a maximum of 15%, that's the capital gains tax, REITs are taxed at your ordinary income rate. So in most cases, you are best to invest in REITs in tax-deferred accounts like an IRA, an individual retirement account, or a 401k if you want to minimize your taxes. And I also said that there is an inherent potential limited growth because the 90% rule can limit a REIT's future growth because the government requires the company to distribute 90% of its income to unit holders. Little capital is left over for acquiring or renovating new properties. Some REITs get around this limit by using debts, in other words, leverage. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. So I'm about to wrap up today's show, but I want to have a kind of recap here. So how to invest in REITs. And all you have to understand here is that REITs are publicly traded. They act as regular assets. You can buy and sell them. And REITs they come in many flavors and many categories, from industrial and office, retail, residential, lodging and resorts, to healthcare, self-storage, and specialty. And whether or not you should invest in the REITs depends upon your risk profile, your financial goals, and most importantly, whether or not you're going to need the money, your liquidity level. And in terms of advantages of REITs investing, you have guaranteed dividends, hassle-free real estate investing, low minimums, passive investment, low stock market correlation, liquidity, better performance, and mandatory distributions to investors. In terms of disadvantages of REITs investing, you have declining value properties, fees and markups, potential market correlation. Gains are taxed at ordinary income rate, and there is inherent potential limited growth. So the bottom line here is that real estate has proven to be a very great long-term investment. So buying property often comes with a sizable monetary investment. In contrast, REIT investing is a great alternative to owning real estate directly. You don't have to spend as much money as you would if you were to buy real property. REITs have some disadvantages compared to owning real estate directly. But REITs are a natural, passive way to gain exposure to real estate without having significant cash. So REITs can add stability and diversity to your overall investment portfolio, especially if you're thinking about the long run. If you have an investment horizon of, say, 10 years or 15 years or 20 years, REITs can be a great addition to your portfolio. Thank you so much for listening to today's conversation. I really appreciate it. I will see you next time, but until then, remember, stay marvelous.